Let me describe someone to you. She's 34, clean driving record, no accidents in 8 years, no tickets in 6. Drives a 2019 Honda Accord, one of the safest cars on the road. Good credit score, 740. Stable income, homeowner. She's literally the dream insurance customer. Her car insurance premium, $2,400 a year. That's $200 a month for a car worth maybe $18,000. She's paying over 13% of her car's value annually just to legally drive it. She's been with the same company for 7 years. 7 years of loyalty, on-time payments, 0 claims. And every single year, her premium goes up. Not because she got in an accident. Not because she got a ticket. It just goes up. Last year, $2,240. Year before, $2,080. This year, $2,400. That's a 15% increase in 2 years for doing absolutely nothing different except becoming a more experienced driver. She did everything right, maintained good credit, drove safely, stayed loyal for those loyalty discounts, even bundled her home and auto like the commercial said. So why does it feel like she's being punished for being a good customer? Why does her insurance keep getting more expensive when her risk keeps getting lower? If you've ever looked at your car insurance bill and thought, I haven't had an accident in years, why am I paying more than I did when I was a riskier driver? This video is going to make a lot of things click into place. My name is Bobby, and I spend way too much time thinking about why the car insurance industry operates like a reverse loyalty program where your reward for being a good customer is higher prices. If you're someone who pays for car insurance, which is basically everyone watching this, make sure to hit that subscribe button and give this video a thumbs up if this helps you understand what's actually happening with your premiums. Here's the thing. We've been sold this story about how car insurance works. We're told that if you're a safe driver with good credit and a reliable car, you'll pay lower premiums. We're told that loyalty to one company gets rewarded with discounts. We're told that bundling policies saves you money. We're told that shopping around is too much hassle because the differences between companies are minimal anyway. That seems logical, right? Insurance is about risk. You're low risk, you pay less. You stick with one company, they reward your loyalty. You make their life easier by bundling multiple policies. They give you a break on the price. That's just good business sense, except that's not what's happening. What's actually happening is one of the most sophisticated price manipulation schemes in consumer finance, and it's completely legal. It's so normalized that most people don't even realize they're being systematically overcharged. The industry even has a term for it, though they'll never use it in their marketing. It's called price optimization. And what it means is this. Your insurance company isn't charging you based on your risk. They're charging you based on how much they think you'll tolerate before you leave. They're charging you based on your loyalty, your inertia, your likelihood of shopping around, and your psychological price sensitivity. They've built algorithms that predict not what you should pay based on actuarial risk, but what you will pay based on behavioral psychology. Let that sink in. Your premium isn't calculated by how likely you are to file a claim. It's calculated by how likely you are to notice you're being overcharged and do something about it. Let me take you back to the 1990s for a second, because understanding the history is crucial to understanding the scam. In the 1990s, car insurance pricing was relatively straightforward. Companies used actuarial tables based on genuine risk factors like your age, driving record, type of car, where you lived, and how much you drove. They'd calculate your statistical likelihood of filing a claim, add their profit margin and overhead costs, and that was your premium. If you were a safe driver with no claims, your rates would generally stay stable or even decrease slightly as you aged out of high-risk categories. Young drivers paid more because statistically, they crash more. Older, experienced drivers paid less because they crashed less. The system wasn't perfect, but it made sense. It was based on risk. Then something changed. In the early 2000s, insurance companies started getting really good at data analytics. They started collecting massive amounts of data, not just about accidents and risk, but about customer behavior. How long do customers typically stay with one company? What percentage of customers actually shop around each year? Which demographic groups are most likely to switch insurers? Which ones just auto-renew without looking? And they discovered something remarkable. Most people, even when they're getting screwed on price, don't leave. According to a 2018 study by J.D. Power, only about 8% of auto insurance customers shop around for new rates each year. That means 92% of customers just accept whatever price increase their company sends them. They open the renewal notice, see the new premium, maybe complain to their spouse about it, and then pay it anyway, because switching seems like too much work. This discovery changed everything. Insurance companies realized they were leaving money on the table. They had loyal customers who weren't price sensitive, who wouldn't shop around, who would just keep paying more and more as long as the increases came gradually. These customers were gold mines. They cost nothing in claims, but they could be charged premium prices simply because they wouldn't leave. So the industry developed sophisticated pricing algorithms that segment customers into different buckets based on their likelihood of shopping around. There are a dozen factors they use, and none of them have anything to do with how safe a driver you are. They look at your education level because people with advanced degrees are statistically more likely to shop around. They look at your occupation because certain professions have higher switching rates. They look at how long you've been with the company because the longer you stay, the less likely you are to leave. They look at whether you've called to negotiate your rate before because that indicates price sensitivity. They even look at completely absurd things like whether you use their mobile app, whether you've gone paperless with your billing, and what time of day you typically pay your bill. All of this data gets fed into algorithms that create a price sensitivity score. And that score determines not what you should pay based on risk, but what you will pay based on psychology. Here's how it works in practice. And I want you to be honest with yourself about whether this applies to your situation. Let's say you're that 34-year-old woman I described earlier. You get your car insurance when you're 27. You're a new customer, so the company offers you a competitive rate to get you in the door. Let's say $1,200 per year. That's the acquisition price. It's genuinely competitive because they're competing for your business against other companies you're actively comparing. Year one, you're happy. The price is good. The service is fine. You've got no reason to leave. Year two, your renewal comes. They increase your rate to $1,280. That's an $80 increase, about 6.7%. You notice it, but it doesn't seem crazy. Insurance goes up sometimes, right? Inflation, rising costs, whatever. You pay it. Year three, another increase. Now you're at $1,420. That's a $140 jump, almost 11%. You definitely notice this one. You might even call them. They tell you it's because of increased claims in your area, or new regulations, or rising medical costs from accidents. It sounds plausible. You're annoyed, but you don't have time to shop around. You've got a busy job, maybe kids, a million other things to deal with. Switching insurance companies feels like a huge hassle, so you pay it. Year four, $1,600. Year five, $1,840. Year six, $2,080. Year seven, $2,400. Over 7 years, you've gone from $1,200 to $2,400. That's a 100% increase. Your premium has literally doubled. And here's the thing, your risk hasn't changed at all. In fact, your risk has decreased. You're 7 years older, 7 years more experienced. You've had 0 accidents, 0 claims. By every actuarial measure, you should be cheaper to insure now than you were at 27. But you're paying double. Why? Because their algorithm determined that you're not price sensitive. You're loyal. You don't shop around. You'll tolerate gradual price increases because each individual increase seems small enough that it's not worth the hassle of switching. You're in the high price bucket. You're being milked. Meanwhile, here's what happens if you call them today and say you're thinking about leaving. Suddenly, magically, they can offer you a better rate. Oh, let me see what discounts we can apply. Oh, look, we can get you down to $1,600. The same coverage, the same risk, but $800 less per year. Where did that $800 come from? It was never real. It was just the loyalty tax you were paying for, not shopping around. And if you actually do leave and get insurance from a competitor, you know what that competitor offers you? About $1,300. Because you're a new customer again. You're in acquisition mode. They want your business. So they offer you a legitimately competitive rate, and the cycle starts all over again. This is the scam. New customers get good prices, loyal customers get screwed. The companies are literally penalizing loyalty and rewarding disloyalty. It's a reverse loyalty program where your prize for staying is higher prices. Now you might be thinking, Bobby, but don't they offer loyalty discounts? I get a 10% loyalty discount on my policy. And look, technically, yes, they might list a loyalty discount on your paperwork. But here's what they're not telling you. That 10% loyalty discount is being applied to an inflated base rate. Let me show you the math. Let's say your actual risk-based premium should be $1,200. But because you're a long-term customer who doesn't shop around, they've placed you in the high price bucket and set your base rate at $1,800. Then they apply a 10% loyalty discount. That's $180 off. So your final price is $1,620. You look at your bill and you see loyalty discount, negative $180, and you think, great, they're rewarding me for staying. But you're still paying $1,620 when you should be paying $1,200. The loyalty discount is marketing theater. It's designed to make you feel good about getting screwed. The same thing happens with bundling discounts, safe driver discounts, all of it. They inflate the base rate and then show you discounts being applied so you feel like you're getting a deal. But the final number is still higher than what a new customer would pay for identical coverage. A 2020 study by the Consumer Federation of America found that long-term customers of major insurers paid an average of 17% more than new customers for identical coverage. Some customers were paying over 30% more. That's not a small difference. On a $2,000 premium, that's $340 to $600 extra per year for being loyal. Think about that for a second. You're being charged extra for not leaving. The insurance industry has created a business model where customer retention isn't about providing value, it's about exploiting inertia. They're not trying to keep you by being the best option. They're keeping you by betting that switching feels like too much work. And here's where it gets worse. This price optimization strategy disproportionately affects specific groups of people. According to research from the National Association of Insurance Commissioners, elderly customers, lower income customers, and less educated customers are the most likely to be placed in high price buckets because these groups statistically have lower shopping around rates. Why? Because elderly people grew up in an era where loyalty was actually rewarded, so they're less likely to switch. Lower income people often don't have the time or resources to spend hours comparing quotes and switching policies. Less educated customers are less likely to understand that they're being overcharged or know how to find better rates. So the people who can least afford to overpay are the ones getting charged the most. It's a regressive pricing system that functions like a tax on loyalty, age, and economic disadvantage, and it's completely legal. Now, some states have tried to crack down on this. California, for example, banned the use of price optimization in insurance in 2007. They required that premiums be based solely on actuarial risk, not on likelihood to shop around. And you know what happened? California has some of the lowest auto insurance premiums in the country relative to risk. Customers in California pay an average of 20% less than customers in states without these protections. But most states allow it. Most states let insurance companies charge you whatever they think you'll tolerate. And the companies defend this practice by saying they're not discriminating, they're just using sophisticated pricing models. Which is technically true. They're using sophisticated models to systematically overcharge people who trust them. Let me make this concrete with the actual numbers because I think seeing the math makes it undeniable. Let's say you're paying $2,400 per year for car insurance. You've been with your company for 6 years. Your driving record is clean. You decide to finally shop around. You get quotes from 5 different companies. Here's what you find. Company A, your current insurer, $2,400. Company B, $1,650. Company C, $1,580. Company D, $720. Company E, $1,600. The average of the new companies is $1,638. You're paying $762 more per year, or $63, $50 more per month than you would if you just switched to the average competitor. Over 6 years of loyalty, you've overpaid by about $3,000. That's not counting the compounding effect if you'd invested that money instead. At a conservative 7% return, that $3,000 in overpayments would be worth over $3,500 today. You basically bought your insurance company a nice used car with your loyalty. But wait, there's more. Because even after you switch to Company B at $1,650, that rate isn't permanent either. Company B knows they got you with a low acquisition price. In 2 to 3 years, they'll start raising your rates using the exact same playbook. And if you don't shop around again, you'll end up right back in the high price bucket, just with a different company. The only way to consistently pay fair rates is to shop around every single year. Not every few years. Every single year. Because the moment you become a loyal customer, you become a target for price optimization. And here's what really gets me. The expenses that you're overpaying, that extra $700 to $800 per year, that's not going toward better coverage or better service. Your coverage is identical, whether you're paying $1,600 or $2,400. The extra money is pure profit. It's a loyalty tax that goes straight to the insurance company's bottom line. According to their own financial reports, major auto insurers have profit margins of 8% to 12% in good years. But when you break it down by customer segment, new customers are often unprofitable or barely profitable. Long-term customers who don't shop around, profit margins of 20%, 30%, sometimes higher. You're subsidizing the cheap rates they offer to new customers. Your loyalty is funding their acquisition strategy. Insurance companies spend billions on advertising. Those Flow commercials from Progressive, the Geico Gecko, the Mayhem guy from Allstate, those elaborate ad campaigns cost hundreds of millions of dollars per year. Where do you think that money comes from? It comes from overcharging loyal customers who don't shop around. You're paying for the ads designed to attract new customers who will get better rates than you. This is where the trap snaps shut, and it's the part that the industry desperately doesn't want you to understand. Car insurance is legally mandatory. You have to have it to drive. You can't opt out. You can't just decide not to participate. The government requires you to purchase a product from private companies, and those companies have figured out how to exploit that captive market by charging different prices for identical products based not on cost or risk, but on your psychology. It's like if grocery stores were legally mandatory, and the grocery store you'd been going to for years started charging you $8 for a gallon of milk while charging new customers $4 for the exact same gallon. But you keep going there because you know where everything is, and switching to a new store seems annoying. That's car insurance. A 2022 study by the National Bureau of Economic Research found that the average American household could save $416 per year by switching to a cheaper insurer with identical coverage. Across all households, Americans collectively overpay an estimated $21 billion per year on car insurance because of loyalty and inertia. $21 billion in pure waste. That's not a rounding error. That's not a minor inefficiency. That's a systematic transfer of wealth from trusting customers to insurance company shareholders. Now, you might be thinking, okay, Bobby, but what am I supposed to do? I need car insurance. I can't just not have it. And I hear you. That's exactly the trap. You're legally required to participate in a market that's designed to overcharge you for not constantly shopping around. But here's the mindset shift that changes everything. You need to start treating car insurance like a subscription service that's actively trying to screw you, because that's what it is. Here's what I mean. Most people treat car insurance like a utility or a relationship, something you set up once and then just maintain. You develop a sense of brand loyalty. You think of yourself as a State Farm customer, or with Geico. You feel like switching is somehow disloyal, or complicated, or risky. That mindset is costing you hundreds or thousands of dollars per year. The alternative approach is what I call the annual shopping protocol. You treat your car insurance renewal date like a guaranteed opportunity to save money. Every single year, without exception, you shop around. You get at least 3 to 5 quotes from different companies. You compare not just the price, but the actual coverage to make sure it's apples to apples. And you switch to whoever offers the best value. No loyalty, no hesitation, no brand attachment. This requires maybe 2 to 3 hours of work per year. Let's be honest about that. Getting quotes, comparing coverage, switching policies, updating your payment information, it's not instant. But let's do the math on that time investment. If you save $400 per year, and it takes you 3 hours to shop around and switch, you just earned $133 per hour, after taxes, for a task you can do in your pajamas while watching TV. There is no easier money you will ever make than shopping for car insurance annually. It's literally free money that you're currently choosing to leave on the table because switching feels inconvenient. Let me make this even more concrete with a specific action plan. Here's exactly what you do. Step 1. About 30 days before your current policy renews, go online and get quotes from at least 5 different companies. Use comparison sites like the Zebra or Policygenius to speed up the process, but also go directly to a few major insurers' websites. Make sure you're comparing identical coverage limits, same liability limits, same deductibles, same everything. Step 2. When you get your quotes, create a simple spreadsheet. Company name, annual premium, monthly premium, coverage details. Sort by price. Identify the cheapest 2 or 3 options. Step 3. Look up customer service reviews and financial strength ratings for those cheap options. You don't want to save $200 and end up with a company that doesn't pay claims. AM Best ratings, JD, power satisfaction scores. This takes maybe 15 minutes. Step 4. Pick the winner. Sign up online. Most companies let you choose your start date, so you can have it start the day your current policy ends. Zero gapping coverage. Step 5. Once your new policy is active, call your old company and cancel. Not before. Don't want any gap. They'll probably offer you a better rate to stay. Don't take it, because next year, they'll just raise it again. You're not playing their game anymore.